doing your job here. Perfect. Thank you. Okay. So every class we're going to start with a test. Today we're going to start with a test on a topic that I think bedevils valuation at its core. It's bias. Bias and preconception. So let me lay the foundations here. Now, think about where bias comes. Some of it comes from the subconscious, right? What you hear around you, what you see other people doing. And we're human beings. We're trained to be part of a crowd. So when everybody else likes a company, we feel the urge to like it too. Some of it comes from the power of suggestion. You picked your company because you heard Mark Cuban on CNBC. He was there yesterday, tell you that this company was a good company and you like Mark Cuban. I think that's human nature. In fact, I know one of the most interesting conversations I had was with the head of M&A at one of the investment banks, and he called me and he said, "You know what? I have these teams that do that I use to get valuations, but they always seem to feed me back the value I expected to see." And I said, "What exactly do you tell them when you give them a mission?" He said, "Well, I give them the financials and I give them all of the information about what I think about the company. And then I tell them a rough estimate of what I think the value would be." And I said, "Have you ever thought about what would happen if you never mentioned that?" Because if you mention a number, and then you tell them, "Ignore what I just said," do you think people are just going to erase it and not act like they heard it? It's going to worm its way into the subconscious. And then, of course, there's the power of money. If I pay you to do a valuation, have I created bias in the process already? Yes, because you want to keep me happy. So you're going to feed me what makes me happy. So with that set up, let me go forward and give you a series of questions. These are going to be bang, bang, so I'm not going to even give you a chance to think, because thinking can be dangerous here. I want you to go with your gut. You created your own business and you're valuing your business for sale to a third party, to a venture capitalist, a private equity investor. What I want you to think about is whether there's bias in your valuation. Are you going to be biased high, biased low? Is there no bias? So ready? You're valuing your own business for a third party. Is your bias going to be to push it up, push it down, or there's no bias? I'll make this explicit. Next ones, I won't even ask you. Bucky, what would you do? Bias up, bias down?
High, so up.
You want a high number for your business or a low number?
High number.
Okay, there you go. So you're going to be biased up. I'm the venture capitalist valuing your own business. What's my bias going to be, Bucky? To come back to you with a
Lower.
Much lower number. It's not bad, it's just bias. Let's move on. You're valuing your business, you're going through a messy divorce. You built up this business. And the divorce court is going to split your business into two, and you have to pay your soon-to-be ex-spouse half the value of the business. So let me ask you a question, and I'm going to pick Kushal here. I'm not suggesting you look divorced, but I'm saying, you can probably answer the question. Given that you are going to split this business, do you want this business to have a high value or a low value?
I was going to say unclear, Professor.
Really? Your ex-spouse is a very lucky person. Because remember, this is soon to be your ex-spouse. You want to give half the value of the business. You want to convince the world the business is worth nothing. What's half of nothing? Nothing. So I don't pay anything. Look, the business is worth nothing. It's actually happened in a Texas court with this guy called Harry Ham. I forget his first name. He built up this big oil business, got into a messy divorce. And then at the divorce court, here's what he said: "I'm a terrible manager. This business is worth nothing. You should give my spouse half of nothing so she can get nothing." So if you're looking at valuation, looking for bias, let's say you're an appraiser valuing a business for tax purposes. So whatever value you come up with, the tax guy is going to take 30% of that value. So you're working for the owner in tax court. Stephanie, what's your bias going to be if you're the appraiser working for an owner and you've got to come up with the value, and the tax guy is going to take 30% of that value? Come up with a low number or a high number?
A low number.
Low number. And if you're the same appraiser working for the IRS, appraising the value of that same business, same financials, guess what? You're going to come up with a high number because you want to get 30% of the higher number. Now do you see why so many valuations end up in court? So let's take a look at equity research. You know that there are two ways in which equity research is structured. There's sell-side equity research and buy-side equity research. Sell-side equity research are all those analysts you see working at the big investment banks. They're the ones you see on CNBC. They put out reports and they tell you to buy or sell. You're valuing a company. You're putting a buy or a sell. Is there any bias you think in the sell-side equity? Is there a bias towards buys or a bias towards sells? You want to, it's a tough one, actually. Think about it. You're saying, well, equity research analysts, don't I pay them for their unbiased advice? I wish. Think through the consequences. You know how sell-side equity research is structured? You're given 15 companies and you will track them for the rest of your life. Depressing thought. But you will go to sleep with them, you'll wake up with them, and you go to sleep with them again. You put a sell recommendation on one of those companies. What have you just done? In journalistic terms, you've just burned your source, right? You know what I mean by burned your source? It's just, hey, you need those connections to the company. You put a sell recommendation. And in some cases, it can be worse. The company can threaten to pull its investment banking business from your bank. And the next thing you know, your managing director is calling you and saying, what the heck are you doing? Putting a sell recommendation on Tesla. So guess how this plays out? There are 9 times more buy recommendations than sell recommendations in sell-side equity research, 9 times. And be happy, it used to be 20 times more buy recommendations than sell recommendations 20 years ago. So that's for your sell-side equity research analyst. What if you're a buy-side analyst? Buy-side analysts are the ones who work at Fidelity's. The reason you never hear about them is they actually work within, and their advice goes to the mutual fund manager. So you're valuing a company. Let's say I'm your portfolio manager. You're my buy-side analyst. I already own 1 million shares of Tesla. And I ask you to tell me what you think of Tesla. Do you think it's a buy or a sell? Let me ask you a question. When you come back and make your report, which conclusion is going to make me happier? That you found the company to be a buy or a sell? I already own 1 million shares. I'd love for you to reinforce saying, you did the right thing. I know you're saying, but I'm an honest person. I would never do this. This happens insidiously. You know that what will make the portfolio manager happier is that the stock is undervalued. You're going to push the value up. Whereas if I've sold short of the same stock, you work at Melvin Capital 2 weeks ago. Does Gabe Plotkin want you to come in and tell him that, you know what, this GameStop thing is very dangerous because it could be worth a lot more than the $20 it's trading for? You could try. And in hindsight, you might have been right, but you'd have been fired well before you were right. And let's finally look at perhaps the most biased process known to man, the M&A process. So let's say you are the banker for the acquirer in a friendly takeover. And I've asked you to assess the value of a target company. What's your bias going to be? To push up? Because remember, you want to know, if you come up with a high value, I will do the deal. If you come up with a low value, presumably if I'm listening to you, I won't do the deal. You want to come up with a high value or a low value for the target company? Manav?
It's low.
You won't be in an M&A banker for very long. Because you know what I'm going to do when you come back with a low value? I'm going to try somebody else. How do you get paid, Manav, as an M&A banker? Do you get paid for advice?
Yes, a person.
That's not the way it works. In M&A banking, you know how you get paid? You get paid if the deal gets done. In other words, if you give me honest advice and I actually listen and I don't do the deal, what do you get? Nothing. And if I do the deal, you get 50 million. Do you think this might skew your advice a little bit? 50 million versus 0? asking a banker whether a deal makes sense is like asking a plastic surgeon whether there's something wrong with your face. Because what's the surgeon going to say? You're already perfect, in which case he gets no money. He says your nose looks so long, too long, your lips look too thin. It's not that bankers are bad people. It's just that there's a conflict of interest here. It's endemic in the M&A process, and it applies everywhere. In fact, the target company hires a banker. You know what that banker has to convince shareholders of the target company? That this deal is good for them. And actually, if the deal is good for one, it can't be good for the other, right? You can't be paying less than value and more than value at the same time. But it's amazing how bankers thread the needle. The way they thread it is they create those two magic S words, synergy and strategic considerations. The next thing you know, both sides are, we came out the winner. And in a hostile takeover, it gets really interesting. Because in a hostile takeover, the target company doesn't want to get taken over. So you're the banker for the acquiring company. You got to be very careful as to what you supply for public consumption. You see why? Because you want to show the inside managers this is a good deal because you're paying less than the value, but you don't want it to ever leak out, because if it leaked out to the target company, the manager goes, look, it's worth 80, they're paying only 65. So here's the bottom line with bias. It's unavoidable. It's unavoidable because it's built into the process. So no point denying it. Accept it and be open about it. So what I'm going to start this session with is that issue of bias. So let me close these slides. And go to the other package we're working on. We're on page 3. So this is on the intro to valuation packet. We haven't started, as I said, we'll start the first lecture note packet in a bit. So let's talk about bias. I'm going to start with those two propositions. Every valuation is biased. The question is, where's the bias coming from and how much it is? The second is, the more you get, you tell me who pays you to do evaluation, I'll tell you which direction the bias is and how much the bias is. In fact, I'm reminded of a story, a real life story from almost 30 years ago. A company called Lynn Cable, publicly traded company. AT&T used to own 49% of Lynn Cable, and they had an option to buy the remaining 51%, an option. But the option was written in terms of appraised value. So the time the option to be exercised comes about, and AT&T goes out and hires Morgan Stanley. So Courtney, you're going to be Morgan Stanley. You're AT&T's banker. You work for the buyer. So you have to appraise the value of Lynn Cable so AT&T can buy it. So remember, that's your mission. Matthew, Lynn Cable went out and hired its own investment banker. And I'm sorry to do this to you, Matthew, but they hired Lehman. So think of yourself as pre-bankrupt Lehman, and you work for the seller. So Courtney works for the buyer, Matthew works for the seller. Two bankers, same company, same financials, same point in time, go to work. They come back with two very different numbers. One comes back with $105 per share. The other comes back with $155 per share. So who do you think came back with 105? Courtney, who works for the buyer, or Matthew, who works for the seller? Sahir, who do you think came back with 105?
Courtney,
And why?
because it's in our interest for it to be lower because it's an attractive acquisition target for AT&T. In that case.
It basically means they have to pay less. It's not because she's a bad person. In fact, if she showed you a model, it'd be an Excel spreadsheet with assumptions, and looking at the model, it looked like a valuation model. Matthew, of course, came back with 155 because he worked for the seller. They did their jobs. In fact, when the difference was so large, they decided to call in a third investment banker, an outfit called Wasserstein Perella. And I'm going to say some terrible things about this outfit, but I mean every word of it. These guys couldn't value a $20 bill in a brown paper bag if you put it in front of them. I mean, they'd come up with some multiple, enterprise value to cash in the bag, 3.3. But if you're Wasserstein Perella, you're right in the middle, right? You don't want to piss off either side too much because you got to work with both sides in the future. So Danny, you be Wasserstein Perella. Courtney's come up with 105. Matthew's come up with 155. What's the safest place for you to be?
Which
Take the
Danny?
average.
Or Danny or Buddy?
Take the average.
You take the average, 130, right? You know what Wasserstein Perella came back with? $127.50. I'm going to let you in on a little secret in valuation. Don't let it out of this room. If you're ever asked to value something, never ever come back with a nice round number. Don't tell me something is worth $40 per share. Tell me it's worth $38.87. It's amazing what that second decimal will do in creating an illusion that you actually know more than you do. When in doubt, add decimals. False precision is all around us. Why not add to it? So the bottom line is all valuations are biased. And here's what we should take away from it. Even if you do valuation for a living, you will see other people's valuations a lot more than your own. Banking valuation. So here's my advice to you. When you look at somebody else's valuation of a company, ask yourself two questions. Who paid them to do this valuation, and how much? Before you look at the numbers, look for that bias, because it's going to animate everything you see in that valuation. So that's the first stop, bias. Let's take the second stop. Do you guys like to have a lot of uncertainty in your lives? Stephanie Lee, what do you think about uncertainty? Is it a good thing? Do you like it? Not?
I believe uncertainty can be good.
Okay, but I mean, we're not talking about abstraction. As a human being,
Yeah.
When you face uncertainty, do you feel comfortable or uncomfortable?
Uncomfortable.
We all feel uncomfortable with uncertainty.
Yep.
And we want precision, right? We want the right answer. And there's an unfortunate mythology in valuation that if you do a good valuation, you're going to get the right answer. That the quality of a valuation can be measured by its precision. So let me yank away that comfort. Valuations are not going to be right because you're not God. All valuations are imprecise. And some valuations will be more imprecise than others. A couple of years ago, this actually was front and center during a week of IPOs. And this was about 2019, March, I think 2019, 1 week. 2 companies went public, both with their names starting with L. So I'm going to tell you the 2 companies, and I want you to just pick one instantaneously, because then I'm going to have a follow-up question. One was Lyft. Lyft actually went public before Uber did, a couple of months before. One was Lyft. Young ride-sharing company, money losing, lots of issues in the future. The other was Levi Strauss in the same week. You think Levi Strauss went public only in 2019? Levi Strauss used to be a public company, but in a long time ago, it was taken private. And in 2019, it went public again. Lyft, Levi Strauss. Had a chance to pick a company? Okay, now I have a follow-up question. It's an easy one. Which of these 2 companies is going to be easier to value? Where your valuation is going to be more precise? Levi Strauss or Lyft? Tom Catalano? Which is going to be easier to value?
Probably Levi Strauss.
And what is it about Levi Strauss that makes it easier to value?
I'd say like
You know what it does, right? What is the number? What's the year that you see on the back of your 501? 1876. I mean, this is a company that's got the bulk of its revenues from a product that's been around 150 years. You have lots of financial history. You've seen how it does in recessions, how it does in recoveries. You know its business model. So it's easier to value because you have more to base the value on. Lyft, on the other hand, is in a business that didn't exist until 10 years ago, right? There was no ride-sharing business. It's a business that nobody's figured out how to make money on. Lyft doesn't do it, Uber doesn't do it, Didi doesn't do it, Grab doesn't do it, Ola doesn't do it. It's a terribly structured business. The business model is in flux, their history is not there. So if I asked you which one is going to give you the more precise valuation, it's a no contest. Levi Strauss, you can value more precisely than Lyft. But I have a follow-up question. Which of these two companies will you get a bigger payoff from doing valuation? Remember, the whole idea of valuation is you want to make money on market mistakes, right? In which of these two companies are you more likely to get a payoff from your valuation? Kushal, let me put you on the spot. Let's take Levi Strauss, right? It's easier to value. But think about everybody around you. They have exactly the same resources you do, the same history, the same business model. Guess what? Everybody can value Levi Strauss fairly simply. A 10-year-old could probably value Levi Strauss with a little bit of prodding. There's no differential advantage you bring to the table because you valued a company precisely, but everybody else can do it. In contrast, when you take a company like Lyft, you know what happens when most people try to value it? They give up. There's too much uncertainty. There's not enough history. When you value Lyft, you're actually valuing a company that most people have given up on. It's one of the strange ironies on valuation. The more uncertain you feel about your valuation, the greater the incentive for you to actually complete it, because the payoff you get from valuing a company is much greater when people are uncertain about it. That's why if you ask me what company should I pick for my project, my advice is go where it's darkest. Pick a company where there's a lot of uncertainty, a market where there's a lot of uncertainty. It's going to make your life more difficult because you don't have the crutch of history. But the payoff to valuing those companies is greater than the payoff to valuing nice, stable companies in the middle of a nice, stable market. So uncertainty is a feature, not a bug. Don't try to run away from it. In fact, seek it out in valuation, make your best judgments. Which brings me to a third and final piece in valuation. I remember my first valuation it was 1981, I think. I valued a company. You know how I valued the company? I valued it with an annual report, a ledger sheet, and a calculator. You guys ever seen a ledger sheet? You know what the innovation of the ledger sheet was? The lines came pre-drawn. Huge innovation because I always got the lines going crooked. So you had a blank sheet of paper with 10 columns. And I went through each item, revenues. And each item, how did I do it? I did each year. I used a calculator. It's not rocket science, but it took a long time because each number. When you do a valuation on a ledger sheet, the amount of detail you have is automatically limited because it's so difficult to build detail, especially if you got to go fix something later, right? Because remember, this is not an Excel sheet that just change the revenues, everything else will work out. I'll have to rework the numbers. So data was limited, our models were limited. We built simpler models, not because we wanted to, but because we had no choice. Today, think about it. You have data from every conceivable source. In fact, I'm working on getting you access to S&P Capital IQ. You can download 20 years of data on GameStop in a minute. And 500 line items if you want to. You can put in an Excel spreadsheet and you can build big models. And there is this misconception that the bigger your model, the better it gets. I mean, think of investment banking valuation models. The bloat in those models is insane. Hundreds of line items. Be very careful. It's become easy to build complex models, but there are two costs. The first is the model becomes a black box. Right? You feed numbers in. The model's so complicated, you have no idea what happened in the middle. A number pops out. I remember talking to a sell-side equity research analyst at JP Morgan about a buy recommendation on a stock he'd put out. Stock I was familiar with. The price was 30, the stock was at 80, and I asked him, well, no, why do you think the stock was worth so much? He said, I didn't do it. I said, your name's on the report. What do you mean you didn't do it? He said, no, I didn't do it. ValueMac did it. I said, who the heck is ValueMac? He said, that's our in-house valuation model. I said, what did you do? Sneak into your office in the middle of the night? Value a company and leave it on your desk? But you know what he was trying to tell me, right? Look, don't blame me. I didn't value the company. The model valued the company. Whenever you see those words in a report, the model valued the company, the analyst is trying to evade responsibility, saying, I didn't do it. And with complex models, it's exactly what happens. The second thing that happens is you get what I call input fatigue. You say, what the heck is he talking about? I'll describe it. And if any of you worked at banks, you'll very quickly start to relate to this description. You know when input fatigue will hit you? At about 10 o'clock on a Saturday night, and you're still at your desk. Don't ask me why. It's been a long week. You've been working 15 hours a day for the last 6 days. You think you're done. You get ready to turn off your computer and go home. And your managing director, who's a complete ass, walks in. He throws an annual report on your desk. I want this company valued on my desk first thing tomorrow morning. Why? Sunday morning. This is his trial by fire. He wants to see how much you really want your job. Now, part of you wants to exercise your option to abandon. You say, what does that look like? It's a deeply satisfying option to exercise. It usually takes the form of picking up the annual report, throwing it back in your managing director's face, and you do it yourself. But then the rest of what happens after that is a little depressing. You lose your job, you lose your car, you lose your apartment. You think about it for a moment, but then you say, look, I can't afford to do it. So you sit down to value the company with your in-house model, which has 85 line items. So you dutifully start entering the numbers in, and you do all your homework, line 1, line 2, line 3. You get to input 14, and the clock strikes midnight. You're not Cinderella. You look down, your stomach drops. There are 71 more inputs to go. So you look at the 15th input, says, what was the inventory 5 years ago? Part of you wants to go look it up, but it's too exhausted to get out of the chair. The other part of it says, enter a random number, let's move on. It's amazing how quickly the random numbers roll out. Here's the scary thing. When the output rolls out, it all looks the same, right? That input you spent hours and the input you just made up on the spot start to swim together. This last summer, my son was working at he was a junior at Yale, at a summer internship working at a hedge fund. And he called me and he said, and he almost never calls me for advice related to finance, because what do I know about finance? So he called me, says, look, I was asked to build a discounted cash flow model for my company. And since you teach this, I thought you would have. And I said, what do you need to do? He said, I need to forecast all 3 financial statements. If any of you worked at a bank, you know this exercise, right? Forecast income statements, balance sheet, statement of cash flows. Now, where do I start? And I had to make a confession. I said, in 40 years of valuation, I have never, ever once in my life forecast all 3 financial statements. He said, how do you value a company without forecasting the statements? I said, why do I need the statements? I need 4 items or 5 items out of the statements. Why am I forecasting our days receivable for the next 30 years? So I'm going to make a suggestion as you approach valuation. Less is more. Never add detail unless you can bring something to the detail. 40 years of valuation, I've never broken working capital down into its constituent parts. You know what I'm talking about? Receivables, payables, inventory, because you know what? I'm incapable of forecasting inventory for the next 30 years. If you're good at that, I bow down to you. But since I can't do it, why the heck break it up? Because you can mangle some really simple assets using complex models. I'll give you my favorite example of a simple asset that gets mangled with complex models. You take any company in the world and you look at its balance sheet. It's a bunch of different assets, right? But there's one asset on a balance sheet that should be easiest to value. Which one is that? Justin, you want to try? You take any company, you look at the balance sheet of all of its assets on the balance sheet, which one should be the easiest one to value?
Cash.
Cash. And you'd be amazed at how many emails I get every week from people who claim to have invented a new way to value cash. So here's how the email will begin. Professor Deodorant. It's amazing what Microsoft spell check used to do to my name, but at least I smell good. I don't contest it. Said, I've spent the last 6 months of my life building this model to value cash, to which my response is, what an empty life you must have. Could you please take a look at the attached Excel spreadsheet and tell me whether I did a good job? I don't even look at the spreadsheet. I programmed the F7 key on my computer to respond. I hit it. You know what it says? Have you tried counting it? It usually works with cash. Because when you build models to value cash, here's what happens. Let's take a company, Google, 100 billion in cash. When you see cash and marketable securities as a line item on a company's balance sheet, especially in the US with IFRS or GAAP, what has to be true about where that cash is invested for it to qualify as cash, as a cash line item? Justin, you want to try? What has to be true about cash for it to be treated as cash in a balance sheet? Where does it have to be invested?
In the United States?
No,
Or
it doesn't have to be domestic. It has to be invested in something liquid and riskless. Liquid and riskless. Let's carry this to the next step. If you're looking to invest in something liquid and riskless right now, you're talking about T-bills, close to riskless maybe, liquid because you need to get out. Bonds don't work because the price could change. What's the rate of return you're going to be making on that 100 billion? Today, the answer is close to zero. The T-bill rate is close to zero, but even a year ago, maybe 1%. Let's take that 1%. Let's give them the upper end. You take $100 billion, you're invested in liquid and riskless investments making 1%. You project the income from the cash. Remember, it's a model. So you project the income from the cash. And once you project the income, all is lost because now the Pavlovian response kicks in. This is the response you acquire after you go to business school, because once you project numbers in the future, what are you trained to do? You need to discount them back to the present. To discount them, what do you need? A discount rate. You say, this is why I got an MBA and paid $200,000. You open up your corporate finance book, you pull up a beta, risk-free rate, risk premium. Next thing you know, you got a 10% cost of capital. Google, you're really doing well here. So let's see what you have. You have $100 billion invested close to risklessly, making 1% a year. You're projecting the income and you're discounting that income at a 10% cost of capital. What do you think is going to happen to the $100 billion in cash? Ariana? You have 100 billion cash earning 1% a year. You discount that 1% income at a 10% discount rate. What's going to happen? What's the present value going to look like? I can't hear you.
I was going to guess it goes down, but I could be wrong.
It's going to go down a lot. It's going to be about 75 billion. This is magic. You wiped out 25 billion. You know, the fundamental flaw there is if it's riskless, what should the discount rate be that you use on those cash flows? A riskless rate of 1%. And guess what you get? If you take 1% income and discount back at a 1% rate, you get 100 billion. Magic. You'd be amazed at how often I see people taking simple assets and mangling them because they feel this urge to put it into this complex model. So I'm not saying avoid detail. I'm saying introduce detail only if you feel it serves your purpose. Because if it doesn't, why bring it up? So what I'd like to do now is present you with what I call the Bermuda triangle for valuation. It's got three sides. It's got bias, it's got complexity, it's got uncertainty. And I call this the Bermuda triangle because faced with those three problems, analysts get sucked right down the middle. You lose every ounce of good sense you brought in the problem. The biggest enemy against good valuations is not that people don't know models or that they don't have the right risk and return model. It's bias, the unhealthy ways we deal with uncertainty. Like what? We say there's too much uncertainty. So you know what I'm going to do? I'm going to apply a price earnings ratio on next year's earnings and act like the uncertainty goes away. And worst of all, when faced with this problem, we build complexity. We'll build more and more detailed models, acting like that's going to take care of the fundamental problems. So here are the three ways you can put a number on something. The first is intrinsic valuation. In intrinsic valuation, you value an asset or a business based on its expected cash flows and the risk in those cash flows. That's it. Now, the way you do it might be with a discounted cash flow model or some other model, but an intrinsic value is the value of a business comes from what it does. As opposed to what? As opposed to a pricing, where you say, look, what I pay for a business is what other people are willing to pay. So if I have a lot of users and people are paying a lot per user, then I'm going to have a high pricing because that's what people are paying. Not wrong, but a very different perspective on putting a number. And the third, as I said, is contingent claim, where you have a cash flow that's contingent on something happening, you bring an option pricing model. People act like there are hundreds of valuation models out there. Every single valuation model out there has to fall into one of these three buckets. It's the first thing to ask. When somebody says, I have done a valuation, look at what they've done and put it into the right bucket, because the rest of the discussion comes out of putting it in the right bucket. Now, behind every one of these approaches is a presumption or a belief about how markets make mistakes. Now, in last class, I said, look, if you believe in efficient markets, kind of valuation becomes an afterthought. It's what you do to kind of get to the price. So when you do intrinsic valuation of pricing, you're assuming markets make mistakes, and you're also assuming that markets correct their mistakes. Remember that second part. Because I know people look at market efficiency with a lot of contempt. That's so crazy. That's so academic. But guess what? We all believe in market efficiency. The question is when markets become efficient. So with each of these approaches, I'm going to talk about the approach in general. I'm also going to talk about what we assume about markets for that approach to work. And already we're laying the foundations for which approach works for you, because I'm not going to thrust my approach on you, because that's not right. You have to make your own judgment. So let's start with intrinsic valuation, or the version of intrinsic valuation we tend to see, discounted cash flow valuation. I do a whole session, which is titled, just because you have a D and a CF doesn't mean you have a DCF. Because people think, I have a D, I have a CF, it's a DCF. If you look behind the D and the CF in a discounted cash flow valuation, you're arguing that every asset has an intrinsic value. You think that's obvious. Doesn't every asset have an intrinsic value? There are people who contest it. There are people who argue there's no such thing as intrinsic value. You talk to many. I'm actually, sometimes I'm on the evening show on CNBC with the traders. I love being on that show because there's no artifice. They're not hiding behind things. They're pure traders. And you know what they tell me? What is this thing you talk about? I mean, and they do it in a healthy way. This is this value thing. Nobody really cares about it. Who cares what the value of Tesla is? There's no such thing. But in intrinsic valuation, you believe there's an intrinsic value and that you can find it. It's a faith part. And to do an discounted cash flow valuation, think of what you need. You need a life for the asset. In other words, you got to tell me, how long will this asset last? 10 years, 15 years, 20 years, maybe even forever. I need cash flows over that life, which means I have to estimate the cash flows. And third, I've got to come up with a discount rate that reflects the risk of the cash flows. Remember the old saying, you give me a lever, I can move the world. You can make your discounted cash flow models as complex as you want, but ultimately break them down. There's cash flows, there's a discount rate, there's a life for the asset. But let's think about what you need to happen for you to actually make money on intrinsic valuation. Remember I said, this is not an intellectual exercise, it's a pragmatic exercise. For you to make money on intrinsic valuation, let's see what has to hold. First, you have to assume that markets make mistakes. Reasonable assumption. I don't think you'd have a single person in the world who disagrees with you. Even people who believe in efficient markets will concede that. Of course, markets make mistakes. That was easy. Second, you have to assume you can find those mistakes with your intrinsic valuation models. Now we're on dangerous ground, right? Because it depends on the quality of your valuation and whether you've done it right. But let's say you're right. Let's say you find a market mistake. Let's give the market mistake a name. Let's assume it's AMC. What's AMC trading at today, right now? Anybody know? After the run up, it's probably $50 per share, something like that. Let's say it's $50 per share. And you value AMC at 75. Here's the third assumption you need. Even assuming you're right about the 75, for you to make money, the 50 has to move to 75. The market has to correct its mistakes. And here's the frustrating thing. How do you make markets correct mistakes? Hey, you want 1,000 shares of AMC. What are you going to do? Get on the Reddit board and keep posting over and over again, markets made a mistake. Hey, maybe that's not a bad idea. Maybe you should try that. It seems to work for other people. But the reality is you don't control the third link. The only consolation price I can offer you is if you're right about the value, the longer your time horizon, the greater the chance that the market will correct its mistakes. Because reality and truth is ultimately the earnings and cash. You say, how long? I don't know. It could be 3 years, 5 years. Now do you see why most people talk the intrinsic value talk, but they can't walk the walk? Because embedded in intrinsic valuation is a requirement that you need a long time horizon. If you have it, you're more comfortable with intrinsic valuation. What if I don't? I'll give you another alternative. So let's think about the pluses and minuses of discounted cash flow valuation. Discounted cash flow valuation, you have to confront the business the company is in. You can't just look at PE ratios. So if you're valuing GameStop, what do you have to understand? You have to understand, why is GameStop in trouble? And the answer is not difficult. It's because their bulk of their sales come from stores and malls. And even prior to 2020, fewer of us were going into malls. And even those of us who went into malls would go into a GameStop store, find a game we like, check the price, and then what would we do? We'd walk out of the store on our phones, we'd get on Amazon.com and order the same game for $1.50 less. This is not rocket science. We can see why they're in trouble. But it goes to the core. To do an intrinsic valuation, you have to understand the business. There's an old saying that Warren Buffett put out, and lots of things that Warren says he doesn't actually do. He's a little bit hip. But this one, I think he does. He said, I don't buy shares in a company, I buy a piece of a business. That's the intrinsic value view of the world. And because you're buying a piece of the business, you're less exposed to market moods, which can push the price in every conceivable direction. The value of GameStop did not go up tenfold last week. Unless there's some alternate universe where GameStop stores are opening up and people are going in droves. The value did not, but the price did. And when you think about intrinsic valuation, in some ways, what you're trying to do is immunize yourself against the crowd. It sounds like a strange thing to do in a world where we worship crowds. But the essence of intrinsic valuation is crowds can make mistakes. I don't want to be part of the crowd. I'm not trying to sell you an intrinsic valuation, because those same benefits can come back to bite you. These are the disadvantages of intrinsic valuation. First is, it's a lot more work, right? How do I price GameStop? I put a PE ratio on earnings 3 years from now and done. It takes more work. You have to make estimates for the future, which means you're going to be wrong. People are going to say, that was wrong, that was wrong. You got to be ready for that. And finally, and here's, I think, a challenge in intrinsic valuation. I teach a certificate class in investment philosophies. And there was an Indian portfolio manager who was in the class, and he said, look, I'm an intrinsic value investor, but I face a problem. And here's what his problem was. He said, I'm restricted to investing in only Indian companies, but every company I'm looking at looks overvalued to me. You see why this puts him in a really bad spot? If you're a portfolio manager supposed to be investing in Indian equities, and you come back and say, look, I kept all my money in cash because I couldn't find something. How long do you think you're going to be a portfolio manager? If you're an equity mutual fund manager, you can already see the problem with intrinsic value is you might not be able to do your job. So let's look at what needs to come together for intrinsic valuation to actually work for you. These are the conditions. The first is it works only on assets that have cash flows. You can't do intrinsic valuation of collectibles, cryptos, it doesn't work. So it's got to be asset-based. Second, let's think about the kind of investor for whom intrinsic valuation will work best. The first is it's got to be an investor who not only tells you they have a long time horizon, but actually has a long time horizon. You see why I'm separating the two? I'll wager if I did a poll here and said, do you have a long time horizon? Every one of you is almost programmed to say yes. You know why, right? Because if you pick a short time horizon, you're shallow, you're a speculator. I mean, think of all the bad words that go with short time. We're trained to say we have a long time horizon. But do you actually control your time horizon? You know what I mean by control your time horizon? You're 81 years old. Don't even talk to me about long time horizons. The clock is ticking. Your time horizon is set by forces that are beyond your control. It could be your health, it could be your age, it could be your family circumstances. It could be your clients if you're a portfolio manager. Because you know what your time horizon is as a portfolio manager? It's a time horizon of your shortest term client. Because they come every 3 months and say, what have you done for me lately? Guess what? I don't care what your intrinsic time horizon is, you're going to have a short time horizon. I'm going to ask you a question about Warren Buffett. As I said, legendary investor of the 20th century. An intrinsic, when you think intrinsic value investor, you think Warren Buffett, right? Warren Buffett had one big advantage working for him through the last 20 years of the 20th century and continuing into the 21st century that a typical portfolio manager did not. When you think about Warren Buffett investments, what's the vehicle he used to make those investments? He didn't make them personally, he made them through Berkshire Hathaway, right? And what's the biggest operating part of Berkshire Hathaway? It's got, I know See's Candy, I love See's Candy, but See's Candy is so tiny you wouldn't find. What's the biggest operating part of Berkshire Hathaway? You've seen their ads, I'm sure. It's Geico, an insurance company. Who cares? You know what Berkshire Hathaway is? It's an insurance company with a closed-end mutual fund. Because when you're an insurance company, you collect premiums, right? Those premiums get invested. Most insurance companies get invested by very average people. You don't get any upside from the investment. It's basically you're viewed as an insurance company. In the case of Berkshire Hathaway, you had insurance company capital being invested by somebody who's viewed as the best stock picker in history. You say, what's the big deal about investing in insurance company capital? Insurance company capital comes with time horizons, but you know what the time horizon is set by? Actuarial tables. The actuarial tables don't panic on you. You could be in the middle of the 2008 crisis, and guess what? Your life insurance money is still due 11 years from now. And Warren Buffett has used that advantage to maximum effect. In 2008, November 2008, at the height of the crisis, he took positions in both Bank of America and Goldman Sachs. No portfolio manager could have done that because they were all too close to the edge. Client withdrawals were running, way above expectations. But he could because he was investing insurance capital. It's that time horizon that gives you the advantage. So it's nice to have a long time horizon. Not all of us do. The second is, wouldn't it be nice if you could actually act as the catalyst? Remember I said you make money from the price moving towards the value? It'd be nice if you could act as a catalyst that makes that happen. Can you think of any investors who can act as catalysts? What does a Carl Icahn do when he takes a position in a company? Does he stay silent and underground? The minute he takes a position in a company, he's on CNBC, have you noticed? He's public, he's open. And he tells you why he thinks this company is a good company or a bad company. That improves your odds, right? It doesn't make it 100%. Now, remember Herbalife, right? Where you had Carl Icahn on one side and Bill Ackman on the other, one short and the other long. And They fought themselves to a standstill. And thirdly, and this is a personality issue. People ask me, should I be an intrinsic value investor? I ask you, are you a patient person? You know what they all say? Of course, I'm patient. And then they go to the microwave. They've said it for 2 minutes. Say, why is my tea not ready yet? Hey, guess what? You might not be right for intrinsic valuation because it requires a personality that is patient and not that subject to peer pressure. If you were the kind of kid who your classmates all hated you because you were a contrarian. Everything that anybody did, you did the exact opposite. Every year you played on the swings, you were on the slides. You're a good candidate for intrinsic valuation because the nature of intrinsic valuation is often going against the crowd. So that's the intrinsic valuation part. Let's talk about pricing. Any questions about intrinsic valuation? Because as I said, we're going to spend a lot of this class delving into the details, but I want you to at least see the big structure of intrinsic valuation. Any questions on intrinsic valuation? So let's talk about pricing. The price of an asset is based on what other people are willing to pay for similar assets. And it's been a long time since you actually bought tickets to a concert or a baseball game. I remember 2 years ago, I wanted to go to the Yankees game. It was too late to actually buy the tickets at the gate. I went on StubHub. And you might have your own site. You go to StubHub and you say, I want a seat in the balcony level in this section overlooking home plate. How do I decide how much I'll pay for a ticket? I look for other tickets in that section, look at what they're being priced at. And you know what? This looks like a cheap ticket. In fact, I don't know, SeatGeek, I think, is the one that actually breaks deals down into great deals. Have you ever seen this? They actually so what magic must they do? All they do is they compare the price of a seat to other seats in that section. Say, this looks like a great deal. That's pricing. And philosophically, when you do pricing, you're saying, I don't know what an intrinsic value is. I'm going to let the market tell me what to pay. And to do in pricing, here's what you need. This could be pricing of real estate, pricing of Picasso, pricing a stock. You need to first find other assets like it. And already you can see the difficulty, right? Even with a Picasso, not all Picassos are made equal. Remember that the painting that the Saudi royal prince bought last year? Was it the ugly Mona Lisa, as I call it? Basically, it's you decide to pay $450 million. Just because you have a famous artist doesn't mean all their paintings are priced the same, but you have to that's why we pay 6% to an appraiser at Christie's to tell us how much a painting is worth. They're doing the pricing. You need an identical or similar assets. You need to standardize prices. I'll give you an example. If you're in real estate and you're trying to buy an office building, and you know what somebody paid for the building next door, you know what you have to adjust for? That one has 6 floors and the other is 10. One is 10,000 square feet and the other is 15,000. So, realtors divide the price you pay by square footage. It's a price per square foot. Standardized. In the context of stocks, this shows up as a PE ratio and EV to EBITDA. That's a standardized price. So you find comparable assets, you have a standardized price, and then you have control for differences. In real estate, this building is new, this is old. This is updated, this is not. In the context of stock, this stock is high growth, this doesn't. Controlling for differences. And let's think about the kind of mistakes markets must make for pricing to. Where are you getting the pricing? By looking at how the market is pricing other investments like yours, right? Implicitly, you're assuming the market's right on average, but it's wrong on this particular stock. It's a very different perception on pricing than in discounted cash flow valuation. And you also argue that because it's so visible, the corrections happen sooner. In other words, if you have a stock trading at 5 times earnings in a sector where everything else trades at 15 times earnings, it sticks out like a sore thumb, so the correction happens sooner. Remember I asked you about your time horizon? If your time horizon is 6 months or 3 months or 9 months, you're better off playing pricing games than value games because you don't have enough time for corrections to happen. So as I list out the advantages of pricing, you're going to see DCF flipped around. In pricing, you're always in sync with the market. You're never going to have any trouble finding underpriced stocks because it's always relative to average. It's like walking into a room full of obese people and picking a person and say, are you fat relative to everybody else? You're going to, on a percentage basis, there are going to be thin people even in a room full of obese people on a relative basis. I know it's a horrible analogy. But in pricing, you're always going to find things that are underpriced. So if your job as an equity research is to be as a sell-side analyst to put out buy recommendation or portfolio manager, pricing works better for you. And it is easier than intrinsic valuation. At least on the surface, it requires less information. You know what? In pricing, you play what I call the incremental game. What is that? What drives prices? It's the most recent piece of information. So the Amazon earnings report affects Amazon, but nobody's asking, is the base price right? They're just looking at, hey, this is good news, I'm going to push up the price. So if your job is trading on information, pricing is your game. Now, there are disadvantages? Yes. You could create a portfolio of underpriced stocks, but they could be overvalued. You see, how can that happen? Let's say you go into the social media sector. A company trading at 5 times revenues will look cheap relative to other companies. You load up on those companies. What if the entire sector is overvalued? That's what happened to the dot-com bust, right? You bought internet stocks that you thought were cheap relative to other internet stocks, but the whole sector is overvalued. You're going to have a problem. And it is built on the presumption the markets are correct in the aggregate, even though they make mistakes in individual companies. And there's a final point that I will make and reinforce as we get to pricing. There are a lot of people who ask them, why do you price companies? Why do you use a PE ratio instead of doing a discounted cash flow valuation? Their argument is, I don't like to make estimates for the future. It's too uncertain. I don't like to make assumptions about growth and cash flows and risk. And I have some bad news for you. When you use a price earnings ratio of 35, you are making assumptions about growth and risk and cash flows. You're just making it implicitly by the fact that you're paying 35 times earnings. And I'm going to give you a very simple mechanism to back out from your own numbers what you're actually assuming about the future, and it could scare you. The problem is when you're doing pricing, you're not even aware of what you're building in. When you pay $800 billion for Tesla, what revenues would Tesla need to have 10 years out to justify it? You know what? You don't want to know. Why? Because you're afraid that if you knew it, you would never buy Tesla. So if you think about when pricing works, it works best in investments where you have a lot of investments like yours. That's why it works so well for sporting event tickets. It works well for real estate. It doesn't work that well in fine art because it's very difficult to find another piece of art just like yours. And with stocks, the jury is still out, right? In what sense? Let's say you want to price Microsoft. All you have to do is find 10 other companies just like Microsoft. Good luck with that. You're in very dangerous ground in pricing in stocks. But if you think about the kinds of investors for whom pricing works the best, it tends to be investors with shorter time horizons. No judgment there. I'm not saying it's good or bad, shorter time horizons. And if you're judged against other people who do what you do, guess what? You're being judged in a pricing game. How are mutual funds judged? If you go to Morningstar and you say 5 stars, 4 stars, 3 stars for a mutual fund, you know how they make that judgment? Not based on absolute returns, but based on what you did relative to other people like you. So if you're a growth mutual fund, you compare to other growth funds. If you're a value fund, you compare to other value funds. You're judged on a pricing game. And you can supercharge this process if you can take advantage of pricing mistakes in both directions. You know what I mean by both directions? If you're a traditional mutual fund, you have to be long only. You can only buy. So what are you restricted to doing? Buying stocks that you think will go up. I know we glorify hedge funds, but what's the one additional thing that hedge funds can do that mutual funds cannot? They can go short. Not all of them do. What does it allow you to do? It allows you to buy underpriced and sell overpriced stocks. And even if the market is wrong, if you're right in your judgments, as they both converge on where they should be, you walk away. That is the dream of every hedge fund, is to be able to not have to make bets on the direction of the market, but just make bets on corrections. So that's pricing. Any questions on pricing?
Professor?
Yes.
I was wondering, I'm still a little puzzled by the relationship between pricing and the value. If we could just take a piece of real estate, for example, right? I understand the value of that asset is
No,
driven
wait.
by...
You said you understood. To value a piece of real estate, what would you need to do?
I'm sorry?
To value a piece of real estate, what would you need to do?
Right, so we care about the
No,
cash
you
flow.
don't say right. I want you to pause it. Tell me how you value a piece of real estate. What do you need to do?
Right, so we need to know the cash flow, aka the rents.
Okay, so it's rental property. You got to project out the rental property. You take the present value of the rental property.
So what I'm
You get a value of
confused
real estate.
about here
But how
is
do you
that-
price real estate? What do? We look at what other people are paying for similar piece of real estate. You're saying, shouldn't the two converge? Maybe, maybe not. Right? I mean, pricing is driven by demand, supply, mood, and momentum. I've seen times when in cities like San Francisco, New York, where the prices of real estate have gone up 100%, but rental costs have gone up only 15%, or vice versa. If you're a value investor in real estate and you're investing in real estate for the rental income and the cash flows, you know what that effectively means, right? If the pricing process has pushed the price up too much, you're not going to own any real estate in San Francisco because it doesn't make any sense as a value proposition. But you might still, if you're a trader, buy real estate in San Francisco, hoping to do what? That the price will keep going up and you will sell it to somebody else at a higher price. That's the difference between value and price. I'm not saying one is better, the other is good. Very different perspective. Right? Because in the first one, you're buying a business, the cash flows. In the second one, you're buying on the expectation or the hope that the market will keep pushing the price up. And the two can diverge.
I have a question.
Yes.
Are there certain like macro characteristics when you've seen the price and the value converge more frequently than other times?
I don't think you can find, I mean, what usually happens is every pricing excess has an end, right? I mean, think of every bubble in history from tulip bulbs to .com, there was a correction. And people spend years researching it, trying to, because if you find the clues, you found the answer to everlasting investing success, right? Because then you'd get into momentum markets and you'd get off the elevator at exactly the right time. So I'll tell you what my priors are. We know that all pricing excesses come to an end, but it's usually not one big event that causes it. It's a collection of small events that keep building up. Like what? Like the GameStop fiasco. I mean, let's face it. That's kind of you look at it and say, that makes no sense. Why are people doing what they're doing? And you might be able to explain it away to GameStop. Then you see SPACs. You know what SPACs are, right? Basically, you put your money in a blank check company and it tells you it's going to buy an IPO or buy a company. It's essentially a backdoor way of doing an IPO. And you do it on the expectation that the founders of the SPAC are so clever, so smart, that they're going to be able to find you the right target, take 20% of your money and still give you high returns. So that suggests that there's a lot of hope you have in these people doing the right thing. When markets are doing well, you see these things start to build up. And we don't know what it is, but there seems to be one final act where people say, okay, this is too much. And the whole thing unravels. You know why I'm not a trader? Not a trader, but a trader. It's because I don't know what that tipping point is, so I don't try. Great traders are able to sense those tipping points and get out, and there are very few of them out there. So the long answer to your question is, we don't know what causes these corrections, but when they do happen, we know what the consequences are for our portfolios. Traders get demolished, but investors, you still collect the cash flows. Remember, you have enough cash flows to cover your investment. What do you care what the rest of the world thinks about the price? I know it's very difficult to actually get to that point, but that's what we're aspiring for, investment serenity, where you say, look, I don't care what anybody else thinks about this company. I've got the cash flows. I'm okay with the cash flows. When people change their mind on it, that's a side game. I'm okay with it. Easier said than done, but that's what you're aspiring to do in intrinsic value. Jamil, you have a question?
Yeah, I was just wondering, as a company goes down, does
Wait, as a price goes down, or when you say company goes down, so which?
It just as a company's dying, like GameStop, for example.
Okay, so the business model is declining.
Yeah, do the value and the price tend to converge at that point?
Eventually they converge on zero, but no, that's a long time, right? So that's going to give you nothing. The price and the value kind of do this dance, right? Basically, the price exceeds value, strange things happen. In fact, I'm going to post on what I call the feedback loop between price and value, which is, we think of these as separate processes, but sometimes having a price that's higher than the value can benefit a company. Like simply because, in the AMC, how did it benefit the company? The price shot up. What happened last week that helped the company? The convertible debt got converted. It reduced their debt, reduces distress. And they also filed a prospectus providentially on December 11th to issue 178 million more shares at the time of their choosing. So they issue it at a price well above value. You're in a sense collecting that higher price. So as a company declines, eventually there will be convergence because you're looking at liquidation value. And remember we said Levi Strauss is easier to, when you're estimating liquidation value, things get easier because you're saying, what can I get when I sell everything? So the convergence happens not because of magic, but because when you can estimate the liquidation value with a fair degree of precision and liquidation is around the corner, price can't afford to be too different from that number. But I'm not sure that's a basis for making money, right? Because we know that's going to happen, but where in this process would you have to jump in to take advantage of that? Any other questions? And as I said earlier, there are some things that can only be priced. If you get a chance, read this. I'll send you the link to this blog post on classifying every investment into one of four groups. Assets, which have cash flows, therefore can be both valued and priced. Stocks, bonds, businesses. Commodities, which are basically inputs into processes that deliver products and services, generally can't be valued. You can try some macro demand and supply model to try to value oil, but it's kind of pointless. It's usually priced. Priced how? Priced relative to history or priced relative to other commodities. Currencies cannot be valued. A dollar can't be valued. A euro, they can be priced against each other. That's an exchange rate. And collectibles, I'm talking about Picasso's, I'm talking about your baseball card collection, can only be priced. Sometimes it's good to know what you cannot value, because I've seen people frustrate themselves and waste time trying to value something that cannot be valued, like Bitcoin or gold. Neither can be valued, but they can be priced. Now, one of the things we will talk about, which is kind of a detour from the three approaches I said, is what's called asset-based valuation. Accountants love this, right? You take the balance sheets of what is each asset worth. And asset-based valuation usually shows up in liquidation because you're selling each asset. You say, what can I get for this asset? It also shows up in accounting, which is the whole basis for accounting has shifted over the last 25 years from recording what you invested to recording what the accountants think something is worth. It's the notion of fair value accounting, which requires you to actually put numbers on each item separately. And it'll also show up in one final place, and we'll come back and revisit this, called sum of the parts valuation. What does that mean? You have a company in multiple businesses, and you think it's not doing a very good job collectively because it's mangling these businesses. You might decide to want to take it over, not because you want to run the company, but because you want to buy the company and break it up into its constituent parts. We're going to talk about some of the parts valuation and some of the parts pricing. Because an asset-based valuation, you're trying to value individual assets, and that's messier than a company because individual assets on a balance sheet don't release cash flows. If I told you, hey, here's an asset I saw on GM's balance sheet, what are the cash flows from it? There's no way to identify what those cash flows are. So we're going to talk a little bit about the challenge of valuing companies from the bottom up. So I want you to make a pick now, and I don't expect you to be certain about this. Think of it as an early look. Now that I've told you about intrinsic valuation and pricing, of what you would pick given the descriptions I did. And at the end of the semester, after you've got your hands dirty with intrinsic valuation and pricing on your company, I'm going to come back and ask you whether your mind's been changed, right? Because in a sense, I've laid the philosophy. Are you patient or are you impatient? Do you believe in buying a business or trading? And already we have priors. There's no right answer. I want you to pick your priors. And then we'll re-examine those priors. Which leaves me with one final approach. And I'll at least lay the foundations because I don't want to get into detail here. There are some assets that derive their cash flows from something happening, a contingent cash flow. And if that happens, you have an option. Any security that has contingent cash flows is optionality. See, what does that even mean? Let's say you graph out the cash flows on an asset. You know when you know you have an option is when your cash flows look like this. You have limited losses, unlimited profits. You have a call option, no matter what you call it. You have limited profits, unlimited losses. You have a put option. Basically, you have. We have in both cases you have limited losses, unlimited profit. In one case, you benefit from an asset going up. The other, you benefit from an asset going down. When we talk about real options, that's how I'm going to start every single discussion. Is I'm going to show you the payoff diagram on a patent. You know the payoff diagram of a patent looks like? You already spent the money to get the patent. So what's the most you can lose? Whatever you've spent. If the patent is commercially viable, you get upside. It's a call option. You're an oil company with undeveloped reserves. You've already got the reserves. The cost is fixed. If you develop them, you get the upside. So I'm not going to talk about direct options. I have zero interest in talking about listed options and warrants. There's an entirely different class for that. I'm not going to talk about convertible bonds. It's a fixed income class for that. Here's what I'm going to focus on. I'm going to focus on indirect examples. As I get a pharmaceutical company, the natural resource company. That's why I call it real options. What's the advantage of using option pricing models? They'll allow you to put numbers on things you could not otherwise put a number on. So an oil company with undeveloped reserves that are all non-viable today, what's your discounted cash flow valuation going to give you as a value? Zero. What's the pricing going to give you? Zero. Who's going to pay for that? But if you think about it as an option, you might be able to attach a number to it. And even if you never, ever actually go through the entire process of coming up and putting inputs into a Black-Scholes option, just recognizing when something is an option is going to drive your decisions. And I'll give you an example. Remember 3 years ago, when Facebook ran into that Cambridge Analytica scandal and stock dropped to 135. I valued Facebook as an online advertising company. The reason I was willing to buy Facebook, even though it looked close to fairly valued, is it looks close to fairly valued just as an advertising company. And you have 2.5 billion users, and you can do other things with that user base. Like what? Sell them entertainment, sell them retail. They haven't done it yet. That's optionality. Recognizing that something is an option is more important than actually putting in numbers and coming up with an option pricing model. Now, truth in advertising. When you apply option pricing models in real options, purists, option pricing purists, blanch, they just go crazy because you got to break pretty much every rule in the book for lots of reasons. Many of the inputs for your model are not observable. When you value a listed option on a traded stock, You know what your starting point is, right? What does the stock trade for? You can see it, you can put it into the model. But when I value a patent as an option, the underlying asset is the cash flows will come out of the patent, which I have to make those judgments. It's much more difficult to value a real option. And if you're not careful, there's a very real risk that you could use the option argument to double count. I'll give you an example. I saw the valuation of a pharmaceutical company. It's an equity research report. It's a young pharmaceutical company with a blockbuster drug working its way through the pipeline. It's got existing drug, but there's a blockbuster drug. So this analyst had projected high growth in revenues and earnings for the company because he said, look, this blockbuster drug is going to pay off, therefore the earnings are going to go up. He came up with a discounted cash flow valuation. And he must have had his valuation book open because he said, hey, I read this chapter in the valuation book that said there's an option in pharmaceutical companies when you have a drug working its way through the pipeline. And he took his value, and I'm not kidding, and he doubled it. He said, you know what, that additional value is for that blockbuster drug working its way through the pipeline. Guess what? You just double counted. Because when you did your discounted cash flow valuation, you built in that drug being developed into your cash flows. You can't do that and add the optionality as well. So in summary, don't get confused by people say, I have a new model, I have a different model. Every time somebody says there's a new way, all I do is I take it and say, hey, that's just something we did and we gave it a different name. It goes into this box. All three approaches are built on presumptions that market make mistakes, and they can give you three different numbers. And already I'm setting you up for a potential challenge. Remember, you have to make a recommendation on your stock after you value your company and price your company. I might not have mentioned, you have to tell me whether you buy or sell the stock. Do you see one of the issues you might face? You might find a company that is overvalued with a discounted cash flow model, underpriced relative to other companies, and perhaps has a different value with options. And I'm going to put you on the spot and say, would you buy or sell? You say, how do I know? You can't give me buy with this model, sell with this, because you can either buy or sell. I'm asking you, which of these approaches do you want to hang your hat on? Which one do you trust? So next session, we're going to start to dive into the details of intrinsic valuation, but review these slides so make sure you have the first lecture note packet ready for the next session. But review these slides because they kind of lay the foundations for pretty much everything else that's coming. Any final questions before?
I just have one question.
Sure.
So I'm guessing for our company that we want to value, we shouldn't choose any cryptocurrencies.
It's not a company, right? Cryptocurrencies are
yeah.
not even an asset. It's not a business. So cryptos you can price.
Yeah.
But there's going to be no valuation involved.
Right.
But if you have a company that has crypto as its base and it's actually earning something on that basis, that's different.
Okay, cool.
Thank you, Professor.
You're welcome. Take care. Bye-bye.
You too.